G'day, and thank you for watching this very special interview or listening to it if you're listening on the podcast feed. This is an impossible interview, but I'm going to do it anyway. Now, it's not impossible because the bloke I'm about to speak to is my boss's boss's boss, though he is. It's not impossible because he's a wonderful and generous person to interview, though he is. Not even that he's eloquent and engaging, because he is. It's impossible because I've known David Gardner for a very long time. I have followed his investing for even longer, and trying to compress everything I want to talk about into what's probably going to be about a 45-minute interview is literally an impossible task. Plus, my intros and my questions are too long, so that doesn't give David enough time to speak. But I do want to make sure you hear from David Gardner. Now, I'm going to just give you a quick intro. David Gardner is one of the Motley Fool's 3 co-founders. He's the company's co-chairman, and most importantly for our particular context, he is the man we call our chief rule breaker, which might sound unusual when you think about the bloke who started the company and helps run the business, but it's particularly important because we're going to talk about rule breaker investing. David, welcome, and thank you for joining me.
Thank you very much, Scott. This is just the latest chapter in, I hope, a many-chaptered adventure novel of our talks together. And if we run out of time this time, just have me back. Let's do it again.
Mate, don't make invitations you don't want me to take up, because I absolutely will if you give me the chance. This is going to be fun, and I want our viewers and our listeners to hear and see much, much more from you. So thank you for the opportunity. I will say, and I'll make you blush, you are the most successful investor at the Motley Fool, and that means we should listen to you because you've got something to say, but it also is because you are at heart a teacher, an educator. You're someone who cares about our members, our colleagues. You care about investing. You care about making the world a better place, both in general and specifically when it comes to investing, and that's really, really important. I do want our viewers and listeners to know that in that success you've had, you are the bloke who recommended companies like Amazon, Netflix, Nvidia, and many more at fractions of their current prices. The returns you have achieved are extraordinary. And again, I'm not saying that just to make you blush or because I work for you, though I do, but because I want our people who don't know you well enough yet to really, really understand why this is such an important conversation for us to have, and why I want them to take a heap away from this. Now, up front, David, you've got a new book out, Rule Breaker Investing. You call it the last investment book you're going to write, so we will get to that. But if you're watching this or listening to this and you don't want to see me or hear from David, and that would be a shame, go and buy the book. It is spectacularly good. The audiobook, by the way, is even better because it's narrated by David, so that's really, really cool. David, let's start at the very beginning. As they say, it's a very good place to start. And maybe before we get into Rule Breaker Investing, give our audience a sense, if you would, of the idea behind this weird company name, the Motley Fool.
Yeah, well, thank you very much, Scott. And what a delight to talk to our chief investment officer half a world away for this special conversation. So thank you for your good humor and also your good sense. You are a wonderful investor, and we have so benefited from your leadership down under. So the Motley Fool name comes from Shakespeare, his comedy As You Like It, the best Shakespeare play of all. And Act 2, Scene 7, it was a fool, I saw a fool in the forest, a motley fool. It's such a nondescript line, but it contains that beautiful phrase, the motley fool. They were the court jesters, as I'm sure most of our viewers know, who were welcome to tell the queen or king the truth, and they did so with humor. And you know, who doesn't love a fool? And as we started 34 years ago, we thought this is a fun position to be coming from because we're going to be wrong. I'm going to make some bad stock picks. I hope we'll have a chance to talk about that in this conversation. And so when you do that, at least you can say ahead of time, hey, we told you ahead of time we're fools. So, you know, don't hate on us too much, as we might say here in the U.S. But at the same time, when you do succeed, that's fun too, because you can say, well, those other fellows are quite wise, but we're fools, and this is how we're doing it. You know, fools break the rules. Fools go against conventional wisdom, Scott Phillips, as you well know. And so I think that's the spirit of the Fool.
Funful. I love it. Mate, can you give us a really quick version too of the origin story? You like origin stories. I know you're a big game, you're a big reader, you're a big science fiction fan, big superhero fan. One of your very, very early multi-bagger recommendations was Marvel, of course. Can we talk about the origin story of the Motley Fool just quickly? Just to pretty much bookend that bit of the story, and then we can move on from there.
Yes. So we began as a print newsletter back before the internet existed. The year was 1993 here in the United States of America, and I had just quit the only job I ever had, because I don't call my foolishness a job. and it was writing for a financial newsletter for a successful television personality here in the U.S. And I had not enjoyed the job, not because of the successful TV guy, but it was just creatively deadening. I would turn in fun articles about finance, and all of the personality would be stripped, and the editorial would be just down to the gray boredom, and then all the reasons you wouldn't want to do whatever I was advocating, like using a discount broker or anything else that I thought would help investors. So I just decide not to do that job. And my brother Tom and his pal Eric, they both went to university together, said, well, David, you just got from a financial newsletter. Why don't we start one? And I thought, well, what are we going to call it? And I started flipping through a book of quotations, and now you know the name I came up with. And I would say within 6 or 8 months, we started answering more questions online than we were spending time printing out our newsletter. And we started falling in love with this new medium, America Online. It was the age in the United States where AOL was king. And we started answering questions on their service. One thing led to another. They invited us to open up our newsletter on America Online. And we said, yes, closed down the print portion. And in some ways, the rest is history, with Fool AU being a bright, beautiful moment for us going back in time.
I'm very lucky, David. I discovered the Motley Fool in 1998 online, and was very, very fortunate to have learned from you, from your brother Tom, from some of the absolute OGs at the Fool, many of whom are still around, a couple have gone. And as you say, the rest is history, both there and here. And I'm very, very grateful for that opportunity. Hopefully, we're doing our best here. Which takes me then to your particular investing style, because from the almost the very beginning, I don't know if it literally was the very beginning, the idea of rule breaker investing was something that you personified, you, that became your raison d'etre, if I like, from an investing perspective. You've for I think the longest time had this idea, which was almost entirely unchanged. I think maybe refined, but unchanged. So again, speaking of origin stories, how do you come up with an investing strategy in 1993 or thereabouts called rule breaker investing? How do you decide the way to win in investing is to break rather than follow the rules?
Well, Epictetus, the Greek philosopher, said no great thing is created suddenly. And I do think that rule breaker investing has been a great thing, at least for me, as I've practiced it and tried to share it out with the world. And it was not created suddenly. I would say in 1993, I had still many notions that I don't have today about how to invest. I was much shorter term in my mentality. I tended to look for niche players. I didn't like the leaders so much. I tried to find off Wall Street hidden stocks that people hadn't heard about and try to get into them before they got popular. And while that can work, and that's a perfectly viable approach when done properly, I soon realized that the real movers and shakers, the great stocks of that generation and this generation, are not just going to be the third player in a niche industry. They're probably going to be a company inventing a new industry and shaping the future. And that's the vantage point I had was working on AOL with our AOL site. And I watched America Online itself become a world beater for about a decade. Stock went up 150 times in value with our recommendation on it. And it taught me so many things. 2 quick lessons that it taught me, Scott. The first is that you should just keep holding a great stock even when everybody tells you it's overvalued. From the get-go, people were saying AOL was overvalued before we'd even bought it. And then we did buy it. And then we kept holding it. And for several years, it was listed as the most overrated stock on the market in the U.S. And meantime, it's just going up and up and up again. And as I mentioned, at its peak, it didn't hold this, but at its peak was up 150 times in value. So lesson number 1, great companies probably trade at premiums for really good reasons, and they usually don't come down from those premiums very often. And so buy to hold. And then the second lesson was just maybe as an entrepreneur, because that's what you and I are as well. We are investment people, but we're also building a business. And Warren Buffett's great line, I'm a better investor because I'm a businessman, and a better businessman because I'm an investor. So I had the opportunity to watch firsthand how a company like AOL or Amazon, which I picked in 1997, how they built out their internet businesses. And that influenced us building out our much smaller internet business. And so I think that, those opportunities were ways to learn rule breaking. And that when people say something's overvalued, that's actually a good sign, not a bad one. And there's some other capital F foolish notions that we might talk about in this conversation, but that's one of them. I think there's a lot of wrong-headed investment thinking that is in a lot of people's minds, and so I'm there to try to challenge that. And of course, some rules are great. We shouldn't break every rule, but the ones that are ossified, old school, rigid thinking, yesterday's news, when people are living their investment lives based on those things like buy low, sell high, which I think is a bad phrase, then I like to talk about it and do something different.
I will give a plug to your Rule Breaker Investing podcast as well later, David, but I'll do it just here because some of the greatest wisdom I've heard from you, and that's saying something because you've got a lot of it, has been through that podcast. And some of the lines that you have repeatedly shared with your listeners, you've shared it with our members as well, of course, inside the Motley Fool as you've been working on those services, they are bywords buy phrases for great rule-breaking investing. And it really does seem, even you mentioned, I just want to drill on this for a second. You're saying you like buying overvalued stuff. And I think for our viewers and listeners who aren't familiar with why that would be the case, objectively, if it was overvalued, you wouldn't buy it. You're not saying you're buying stuff because you think it's overvalued. Your point is others are being, I assume I'll put words in your mouth, too short-term, not realizing the great opportunity. So the fact that others are calling it overvalued is often a sign for you to buy. It's a very contrary approach, very rule-breaking approach. You just touch on that a bit more for us, if you would.
I'd love to, because that may be my most important insight. That my favorite chapter maybe in the book is chapter 12, where I really talk about why people say overvalued and what they're missing. And certainly, Scott, to be very clear, some companies are truly overvalued in this world, and I would not want to buy their stocks at the present price, or maybe at any price, depending on what the company is. So I'm not here to dismiss the word overvalued, but I am here to say when it's applied in some contexts, not only is it wrong, it is completely opposite to the truth. And so when we look backwards and we see my cost basis of 16 cents American in Amazon, or coincidentally, thanks to stock splits, 16 cents in NVIDIA, we can see that not only were they not overvalued, they were the most dramatically undervalued stocks available on the market and became the generationally greatest picks that one could make on the markets. And we did. And we did in part because we thought everybody else thought they were overvalued. Now, why this works without being too glib, because it does take more time in a book to explain. But the headline, I think, Scott, is that a number of factors that matter so deeply to an enterprise's growth and health, well-being, and winning nature, a number of factors are not being calculated in traditional valuation metrics. Traditional valuation metrics are usually multiples of things like earnings or cash flow, or in some cases, book value. And so those are multiples of outputs. What is being missed, I'll give you a few factors that are not being calculated there. Who's the CEO? We now know that someone like Steve Jobs is a genius, and a mediocre also ran like Steve Ballmer, who ran Microsoft sideways for 10 years, is not. Who is running your company? Is it Elon Musk? Whatever you may think of him, I think that he's an entrepreneurial genius. Or is it me, who's not Elon Musk, and you probably don't want running your company, and I'm not. It's my brother Tom, our CEO. But the difference between human capital, some people say, or the founder, the vision, who's running it, is extreme. There are no numbers for the things that matter most. Another quick example, the brand name. Most brands are not factored anywhere in the financial statements. There might be a goodwill asset. If a company overpays another and you can't explain based on hard assets why it paid that price, it's listed as goodwill. And sometimes people would say, well, that's the brand or reputation. But most of the time, that's not captured. The great brands of our time, Apple, are also the greatest sized market caps of our time. And I think that's a really important thing to point out. And there are no numbers for the things that matter most. So I gave you who's the CEO and the brand. I could also throw in who can innovate and maybe the culture of the company. Those things are not being numerically expressed by anybody. Therefore, the great companies all have those things in spades. The worst companies don't have any of those things. And yet we're not factoring them into our valuation models. And so I think we've lived through a few generations now where nobody had numbers for that. And therefore, all the great companies are overvalued. And all the mediocre also-rans are often looking cheap, and maybe we'd be buying it here. And often by people who might be playing cyclicals, which I never would, or are taking a shorter-term viewpoint than I do. So, Scott, that is my best effort in just a few minutes to try to explain profoundly why it's been hidden in plain sight. The intangible values that are the most important things driving business success are not being noticed.
I love that, David. Two things I want to share with our audience who may not be as familiar with American companies as you are. I'm a little bit more familiar, but not as much as you. Amazon, whose shares I own, your cost base, you said, was 16 cents split adjusted. For our listeners, that is now $219 per share. NVIDIA, cost base of 16 cents. $186.58. These are US dollars, of course, right now. That is an extraordinary amount of success. And I have to say, mate, you talk about the components of value that you see. Value depends on the opportunity that you see. What you've just talked about is those things that are forward-looking. Yes, sometimes an analyst will compute a price earnings multiple based on last year's earnings, maybe even next year's expected earnings. But those things you talk about, the brand, the culture, the people, the things that make it a massive success as an organization over the next 3, 5, 10, 20, hopefully 50 years, aren't there. They will be the multipliers, the force multipliers that happen in the future. And it's really hard if you're doing a discounted cash flow analysis to make yourself. If you've done it, you could not have done it on Amazon. That's why people thought it was overvalued, I would submit, way back when you were buying it, was because you had to say, well, hang on, what if this business grows at 20% compounded for the next 30 years? And you kind of, even if I've done that in a spreadsheet when you go, you always can't make yourself type it in because it just feels so recklessly large. How is it? I can't assume that. That's ridiculous. And yet that's exactly what you've done. Can you give us the rowboat, sailboat, canoe analogy, please? Because it's a wonderful, wonderful one. You do it so beautifully. And I think this really highlights the point you're making.
Well, thank you very much, Scott. Yes. So the rowboat syndrome was dreamed up, that phrase, by Jack Bogle, who founded Vanguard, who in the U.S. is the largest asset manager today, largely because Jack decided people should be indexing, and he could build a business with very cheap fees that would allow a large number of people, Americans worldwide, to just own the whole market, let's say, or a whole index, instead of overpaying for managed mutual funds that typically underperform. So that is what Jack Bogle did. And his line, the rowboat syndrome, means this. Jack said, most people are paddling down the river of time with their money as investors, and guess which direction they're looking? They're looking backward because they're in a rowboat. And he talks about why people buy high and sell low, which is the opposite of what you're supposed to do. And he said, well, here's what happens. Someone's paddling down the river of time looking backwards, and they didn't get invested in the first place, and they see shares are up, the markets are up. Oh my gosh, there's a second year in a row, the market's up, and they're like, I should finally get on board. And so they do. And guess what's about to happen when they finally decide to invest? You're right. The market's about to drop. 1 year in 3 on average in the U.S., the stock market drops. And so paddle, 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 looking backward, they now regret 1 year of sitting there watching their first investments decline. They start thinking, I should never have done this. I should have, not listened to myself, or I should have listened to the financial advisor telling me not to do this directly myself, or whatever it is. And so they finally disconsolately, after 1 bad year of the market, guess what they're about to do? They're about to sell, and you know what's going to happen next? The stock market, Scott, is going to go up, because 2 years out of 3, it does go up. This is history, and annualized at 9% rates. So this is the person in the rowboat going backwards, paddling down the river of time. And I've always loved that, and I've tried to do justice to Jack, how he would say it. And I've added 2 more boats. I'll do this quickly, but I've tried to flesh this out fully. So rather than paddle down the river time looking backwards, let's talk about a better boat, perhaps, that we could be in with our portfolios and our money. And that would be a canoe. Because the good news about a canoe, if you've been in one, and I bet most of us have, is you're looking forward. That's great. That's what we're supposed to do with our money. You just talked, Scott, about the power of looking into the future, which is exactly what we should be doing, especially as rule breakers. Not every company is a rule breaker, by the way, but as rule breakers, we're invested in the future. Therefore, paddle, paddle, paddle. Let's look ahead, know what's around the bend, and be thinking about what's coming next. However, I have also spent my time in canoes in the state of Maine, in the far north of the United States of America. I know many of us have done this. I do find canoeing exhausting. You have to keep paddling to get the thing to move, and there are hazards in place sometimes. And so it's really not that fun to go long distances like your whole life long investing in a canoe. So I have settled on my favorite boat, and I think a lot of my fellow fools, we can call us the ship of fools, if you like. Scott, you're in it as well. I do believe Jack Bogle's in it as well. And we're all having free drinks, having fun conversation, because we're in a sailboat, and we're enjoying the power of the wind. We're not looking backwards, and we don't need a paddle. we're sitting there having fun, watching the wind, which represents the stock market's historic 9 to 10% returns, fill our sails and push us forward. And yes, we'll sometimes have the winds in our face, and other times we may have to tack. And you do have some hard times sometimes as a sailor. You could capsize. I hope you can right your boat. But I hope that didn't last too long. But that's my rowboat, canoe, sailboat analogy. And I want for everybody watching us, Scott, to recognize the power of the sailboat. The biggest mistake anybody can make is to get out of that sailboat because they're worried about what's the next 10 minutes of our sail together. When we're really in that boat, we should be that our whole lives long, and let the power of the wind push us forward.
I love it, David. Thank you very much. Let's get to your book. I'm not going to be able to do it justice either in this time we've got, but what I did love it. So when I think about you, I think you're a wonderful investor and you're a very, very lovely bloke. But the words that come to mind, as well as investing, as well as enormous success, are things like whimsy and joy and irreverence and love. Those are not investing words. And yet the book is full of all of exactly that. You're telling the story. You're making the case. This is an investing book. Don't get me wrong. If you're watching this and thinking, hang on, what are you talking about, Phillips? It's an investing book, right? It's a book you should absolutely, please read it. I don't get a cut. David gets a cut. Buy it for David. Don't buy it for me. But most of all, buy it for you, right? You want to read this book. It is spectacular. But the reason I raise those things, mate, personally, because I find that about you for the very longest time we've known each other. But also it comes through in this book in absolute spades. And what I love about the book is, speaking of breaking the rules, your book doesn't start with chapter 1. It starts with chapter O. And as I'm reading, you were very kind to send me an advanced copy, and I had to read through the first chapter or two. And it was just one of those things where I was like, oh, that's just really cool. And the style and the tone and the way you're a born storyteller, the way you tell these stories are really, really wonderful. So starting with chapter O, I thought was O for optional, really, really good. Of course, it wasn't optional. I read it, and it was a really worthwhile book. It was a level set. And I guess you've written this book in a beautiful way because you've allowed anybody, from the non-investor to the absolute expert investor, to pick this up, to enjoy it, to get a lot from it. And that's a really, really, really rare skill, to be able to make it, so accessible. What was the motivation for the book? Sounds like an obvious question, but when you sat down to write Rule Breaker Investing, what were you aiming to do?
Well, thank you for those beautiful words, Scott. I so appreciate what you just said. I was trying to write my final stock market book, which is what this is, and I have written books before. I was writing them in my 20s or 30s, and I was saying things like, this is what I'm going to do. These are the 6 traits of rule breaker stocks. Mm-hmm. Let's break the rules. This is what we're going to do. But the one thing I lacked at that point, now at the age of 59, is I didn't have results. I had theories. I had hopes. I had whimsy. We had fun. We were willing to lose. There were all kinds of, I think, right mindset capabilities that we had in place that I try to share through the book. But what we clearly did not yet have was 26 years of accumulated data, companies that didn't even exist back then, like Netflix or like NVIDIA, barely, startup mode. And that was the time that I started thinking about investing in those companies. Now I've done it. And we held those stocks. The magic of having great investments isn't that you bought at 16 cents necessarily, although that's great. It's that you keep holding so that you can say, I have a 10 bagger, I made 10 times my money, or a 100 bagger, or even 1,000 bagger, which is what both Amazon and NVIDIA are. So I think the key is you have to be able to hold. But more than anything, Scott, I had been keeping notes for this for 15 years. I am a writer. I love to write. I also try to make people laugh. So that was always going to be the goal. But I started realizing somewhere during COVID, I haven't written the book yet. And what if I get struck by lightning, or I get COVID or long COVID or whatever it is? I need to finally write this book. And I did. I finally last year wrote it. It's just come out in the past few weeks. I'm just so happy that I did. Strike me with lightning. I can now die completely happily because I did finally get to share all my best thoughts about the stock market. And I probably will write at least one more book, but those will be about investing, which is a capital I word. It's not a stock market kind of investing. It's how I think about what investing means for us as livers of life, not just investors in stocks. So, but yeah, this is basically, as an athlete, I try to leave all my best stuff out there on the field. I have nothing more to say. This is my final stock market book, and it's also a short read. So that was a goal as well.
Yeah, you've done a brilliant job. I'm glad there was going to be another one. You said, and another in the one of the chapters. Like, oh, that's fantastic. So I'm very excited. Looking forward to the next book you do write, because that'll be a great read as well. Now, you talked about the 6 traits of rule breakers, and I think we won't do them here because we just don't have the time and space. And by the way, that's why you got to buy the book to find out all the details. But not really. But I'm going to ask you to do something unfair. I'm going to ask you, so your book, you have 6 habits of a rule breaker investor, so the person. You have 6 traits of a rule breaker stock or company, and you've got 6 principles of the rule breaker portfolio. Can I be unfair and ask you to choose your favorite child from each of those, just briefly? Would you give us one? It doesn't have to be the most important, because I presume they're all important. They feel free to identify or prioritize. But would you give us one habit of a rule breaker investor, one trait of a rule breaker company, and one principle of a rule breaker portfolio, just to whet the appetite of our viewers and listeners?
Yeah, thank you very much. And that is the organization, the simple structure of the book. We talk about your habits and mindset first, then what we're looking for in stocks. And then if you have habits and you have stocks, you probably built a portfolio. And most people lack any real coaching around how to build a portfolio. Mm-hmm. So I will give you my favorite child from each. And it's very easy for me to remember because it's the first one. It's the first habit, the first trait, and the first principle. So in brief, here they come. My first habit for all of us to develop as rule breaker investors, and I would say any kind of investor, but this book is written for rule breakers more than anyone, is rule number 1, let your winners run high. And that means so much to me because we live in a world where people say things like buy low, sell high. That's the way to get rich, stock market. And I immediately disagree because I'm like, so your third word out of your mouth is sell. So many people, so much of our financial media, we don't do this at Fool AU, but I will say so much of the world is covering the markets 1 minute, 1 day to the next, and all of the focus is on the short term. And very few people have been coached or taught to really hold positions in place. And a lot of people aren't buying shares of companies that they believe in enough that they would commit to holding it for 3 years at a dead minimum, which is another habit that we won't talk about this interview. But habit number 1 is my favorite. It's the only way you're really going to get truly rich through the stock market. You have to hold your best companies and let them multiply, let them compound over time. Rule number 1, let your winners run high. The first trait of stocks that we're looking for is top dog and first mover in an important emerging industry. I said at the start of our conversation, Scott, that I used to look for small, forgotten about companies thinking that I could find them before Wall Street would and I could make money that way. And that can work from time to time, but much more successful for me, the way that you end up with Amazon in your portfolio is you start saying, okay, what are the important emerging industries of this time? You could say these days, artificial intelligence, genomics, you could say solar, new materials, crazy polymers, interesting things happening in our society, new technologies, the bleeding edge, the important ones, and then who are the top dogs and first movers? Who are the companies that are leading us in that direction? And it doesn't always have to be a really, really big thing like artificial intelligence, which isn't really an industry. It's a technology that will spawn many industries. And even Uber didn't come along for the first 10 years of the internet. So things will be AI-driven 10 years from now as startups that will want to be buying then. But I think more than anything, we're focused on those visionary founders. Usually they're pretty young who are starting businesses, and we try to buy those stocks. And that is my favorite, most important trait for finding rule breakers. And again, not everything needs to be a world changer. I'll give a quick example. Here in the U.S., we have a company called Axon Enterprise. I'm sure some of our AU members know about it, but this is a company that invented the taser, the non-lethal weaponry that police officers use to not shoot people, but instead zap them, and not take lives, but instead temporarily pause them as you're shaking there on the ground, apprehended by a police officer who's now using body cameras here in the U.S. to be transparent, which is what we want from our police. And all of that equipment is being manufactured and distributed by Axon Enterprise. They have no meaningful competition and are increasingly going global. So not everything has to be some hot AI sounding something. You're looking for important emerging industries. The final thing I'll say is the first and my favorite principle of the portfolio. I can be quick with this one. It's make your portfolio reflect your best vision for our future. And that's my way of saying in brief that you will do much better and be much more at peace and much more knowledgeable, but I'll go back again to you will do much better mathematically, dollars, y'all, if you go ahead and buy companies that you know well, that reflect what you want from our world, that are companies that when they prosper over the next 10 years, you believe the world will be better, which doesn't mean that Scott Phillips would believe it or David Gardner would believe it necessarily, because we all see different parts of the elephant. But we want each of our AU members to be really one-on-one in touch with the stocks that they own, feeling comfortable, not just comfortable, excited, and believers in those shares of enterprises that we esteem. So that is the first principle of the Rule Breaker portfolio.
Thank you, David. I love it. There's so much more there. Can I say again, please buy the book. Just buy the book. The rest of it is in there. It is beautifully written. You're going to learn an absolute truckload out of it. I continue to learn from David, if not daily, certainly weekly through the podcast and other places. So please check that out. Can we talk a little bit about, you talked about top dog and first mover in an important emerging industry. And I think there's a real question. You don't call yourself a tech investor. You and I sat down and did a video for our members. Oh man, it must be 8-9 years ago now. And I think, I don't know if I asked the question or you made the point, but either way, you made sure I was very clear. You're not a tech investor. A lot of your companies that you've invested in are absolutely harnessing technology, inventing, innovating with technology, but you're not a tech investor. And often we get these labels: capital G growth investor, capital T tech investor. You're a rule breaker investor. So can we break that down a little bit? Because even the examples you've given are technology companies, but you would be at pains, I'm sure, to point out where it's not just a case of the label, but rather what it's doing and how it's doing it.
The language that we use matters deeply to me, Scott, even as just a fellow human being. But in investing, I've really benefited from questioning labels that people are using. I'll give a quick example. Do you all say in the AU that when the stock market goes down, that's a correction? Is that something that you say?
Yes.
Yeah, I think that's the wrong word. Yeah. It doesn't make any sense. The stock market, the idea is always whenever it drops, that would be correct, because we're always overshooting. So we need a correction because it would be correct for the market to drop. But our whole conversation today has pointed out the stock market goes up over time. And so if it's correcting, if it's inaccurate in the first place, then isn't it correcting to the upside an awful lot when it goes down? It's the wrong phrase. And sorry for the mini rant, but these are the kinds of things that I care too much about, I guess. So yeah, the phrase tech stock, I've never liked. I don't think that it means anything. My first appearance on CNBC back in the 1990s, wearing my jester cap, I think I was saying something like, I don't know what a tech stock is. Could you please explain to me what you mean by, or growth stock? What is a growth stock, right? I don't think these are the right phrases. Specifically, I believe that technology runs through everything. And so to say something is a tech stock, maybe some people mean your manufacturing technology, but even then I would say, well, is Netflix a tech stock or not? I don't know. Is Mercado Libre, which is Latin America's Amazon of the Amazon, is that a tech stock or not? And, Walmart itself has used technology for decades to be preeminent in the U.S. Is that a tech company? Probably not, but what exactly is a tech? So you won't hear me saying tech stock. You also won't hear me saying growth investor, because I don't think that means what people think that it means. They also say value investor, which I also question, although that makes a little bit more sense to me than value stock, which doesn't make a lot of sense to me, but it would start getting really pedantic if we went too much further down this rabbit hole, Scott Phillips.
And I love a little Princess Bride illusion on the way through, David. Thank you. I do appreciate that. I don't think it means what you think it means. We talk about, I think your point about tech is wonderful. You think about some of the so-called tech companies, Amazon, Apple, Facebook, NVIDIA, all tech companies, but they're not really. There's a consumer products company there. There's a retailer. There's a social media network. There's a chip maker. Are they all technology? Yes, but then none of them are, and then the term just becomes meaningless. And people say, the tech sector or even the NASDAQ being the tech sector index. The idea that, they do tend to move together sometimes because other people think of them that way. The benefit we have, the opportunity we have is to think differently, which is a nice segue round back to what rule breaker investing is about. Why do you reckon rule breaker investing succeeded? What was it about the approach with that 26 years of history, as you mentioned? What was the observation? And I guess the follow-up question for anyone watching now is, will it still work? Or was it a point in time where you saw a move in the zeitgeist and maybe it's been done, maybe it's too late?
Well, we can never say never or know anything for certain, but I'm very, very confident that rule breaker investing will work for every era. And I really do mean that. I've really made great use of it over the last era, but the whole point of my book is to enable people in the next era to do something that most people aren't doing. Most people are not buying shares directly. They're just indexing. We live in a world of big, dumb money that sloshes around and doesn't have any discrimination between this share versus that one. So if you're a fool, capital F with Scott and me, and buying stocks, most people aren't doing anything like that, and I'm not sure they're about to anytime soon. I don't see a huge revolution of a whole bunch of people who are all of a sudden stock pickers. So I believe very confidently that this will continue to work. Also, what we're looking for is winning in every era, and that is, if I had to boil it down, Scott, to one word, I might say the innovators, innovation.
Nice.
That's really at the heart of every great rule breaker, and it isn't always internet or artificial intelligence as innovation. Sometimes it's a business model innovation. For example, Netflix in the early phase, when it was a fantastic performer for us, but this is before streaming, they were simply sending DVDs. We as consumers sent DVDs back and forth through the mail to them, and it seemed really clunky compared to just dropping off a DVD at your local Blockbuster or whatever we're doing in the AU. And yet what happened there was actually a business model innovation. Reed Hastings, the CEO of Netflix, said, everybody hates late fees. Blockbuster is transactional. Let's do something different. Let's be a subscription business model. And all of a sudden, rather than have late fees, you just mail back your DVD and we'll send you the next one. And so it wasn't any tech innovation. It was a genius switch of business models. So I love Steve Jobs. I love his line, think different. It's a phrase that arguably built the largest, most successful company in the world, and one beloved by many for its brand and what it's done in the world, making computers usable for people in an increasingly complex age. I still love Apple today, a long-term hold. Think different. So, Scott, I think it's the innovators that we should be focused on in every industry. So in any given industry that anybody's looking at, I would say to you, who is the innovator? Who really impresses you? And often it's not Goliath. Goliath loves the world as it is. Goliath doesn't need to innovate. Goliath just wants everybody else to conform to the well-worn pathways that Goliath has carved out for everybody on the way to Goliath's house, where you're going to be paying Goliath. I like, and no pun intended, my first name, but I like the Davids. I like the companies. And the only way that David can defeat Goliath is not by playing by Goliath's rules, but instead by breaking the rules and doing things differently. And so every great innovator from that early AOL, which, by the way, just this week closed down for good, its dial-up service. It was still operating here in 2025. But that was such an amazing innovator in its time. And not every innovator is for all time, but a lot of them last way longer than most people think. And not all of them sort of fade away like AOL. Some of them just keep getting bigger and more relevant, like Meta Platforms or Alphabet or, Netflix today. These are world beaters that aren't going away anytime soon. So, Scott, I think it's about the innovators. And so that's why the subtitle of my book is How to Find the Best Stocks of the Future. We're using the past to learn, and we're celebrating it because we've owned those stocks through the past, and they have been the best stocks, the rule breakers that you could have owned. But I'm focused on the future, and that's where we want to focus ourselves as investors and readers.
I love that. I also love the Steve Jobs, the old Apple ad, here's to the crazy ones. It could have been here's to the fools. So there's some nice symmetry there as well. I would
Definitely. His most famous line, maybe from a speech, was at Stanford graduation when he said, stay hungry, stay foolish. And if anybody hasn't spent just a few minutes on YouTube watching Jobs give that Stanford commencement, you just fast forward to the very end. It now sounds like one of the great advertisements we ever could have not paid for our company. But he had the same simpatico, sees the world the same way that you and I do. And the world is to the rule breakers, the different thinkers, the fools, in my opinion. Not everybody's going to be a fool, and not everybody needs to be to win, but we're winning.
And winning very nicely. You are very well known for some of the lines that you've, as I've started saying, the lines you've repeated regularly have become part of Fool folklore, hopefully part of our members' investing experience. The podcast listeners get the same thing. I've written down just some here. Dips by dips, which I always have quite loved. Add up, don't double down. Buy high, trying to sell, you've already talked about. Losing to win. I might get you to just quickly talk about losing to win. That sounds, again, a little bit foolish, but we'll say capital F foolish because there's some real, well, lowercase w, wisdom in it.
Thank you very much, Scott. This is maybe the most important thing that I can say this whole conversation. I said earlier I wanted to talk about our losers. You've now given me the opportunity to do so. As I started wending down my stock picking career at the Motley Fool in 2021, I looked back and I looked at the last 20 years of making stock selections every single month in, month out, one or two at a time for Motley Fool rule breakers. And I counted 369 separate picks. And I went back and I checked, and this is a horrible, horrible truth. Of those 360 some stock picks, 63 of them not only had lost, 63 of them had literally lost 50% or more of our money. And every one of those I picked, every one of them I felt good about at the time. I never go in thinking I've got it right. I never have that attitude. I'm always playing the probabilities and thinking about how the world can play out. And sometimes you get black swan moments. You can't do anything about them. But truly, Scott, 1 in 6 of my selections had lost 50% or more of its value. And that's shameful. And I hate talking about that, except that it was also true at that point that the 63rd best selection for rule breakers was up about 400%. And if you do the math with me, the worst you can ever do for those really bad stock picks was minus 100, and I never quite did that badly. And the best you can do is unlimited on the upside. And in fact, the single best selection at that point in rule breakers history was Tesla, and Tesla is still up now more than 200 times for our members, but that on its own, think about it, a single stock up 200 times in value literally wipes away all 63 of those minus 50 percenters and leaves a lot of profit on its own on the table. In between my top pick, Tesla, and my number 63 pick, HubSpot, 400% gain, 200 times gain, were stocks that had gone up between 4 and 100 or more times in value, 61 others. And that is why I think Rule Breakers is one of the great advisories of all time. And we lost so often and so poorly. And so this is my way of saying we're not for all. Some people don't have a mentality or even a life circumstance that would allow them to lose in the way that we do to win. But if you are, especially if you're younger or if you are more of a risk taker without being a crazy man, because I'm a fool, but I'm not a crazy man, I highly recommend feeling not bad about losing and not living so in fear of stocks going down, but recognizing the unbelievable upside in front of you, if you will, but buy to hold.
My goodness, that's a great story, David. And if you think about that, just for our, you've made it perfectly clear, but I'll add my 2 cents in the sense that if you had, David, decided, you know what, I'm going to try and minimize the number of losers. I'm going to shave off some of the rough edges. I'm not going to take those, you call them risks, I'll call them calculated investments, but they're the same thing. I guess I think it's a positive thing. But the idea of you could have maybe reduced that 63 down to 40. And then of those top 40, maybe you might have taken out Tesla. You might have taken out the Nvidias or the Amazons or the Apples or the Marvels, the Disney. Those things you may say, well, I won't take that risk. I'll take that risk. What you've shown very clearly is by doing it the way you've designed it, the rule breaker investing philosophy, yes, you've got to make your peace with the occasional, maybe even more than occasional loser in the process, in the journey towards finding those winners that mathematically play out. And I love to use the word probability because we kind of think about it as maths, we think about it as gambling. Investing at its very core is the idea of probabilities, buying something for less than it's worth, not as a capital V value, just the idea that I think this will be worth a lot more in future. And if I'm right more than I'm wrong, and when I'm right, I'm much, much more right than I am wrong when I'm wrong. The maths is just the maths, and it's a shame we don't sort of share that more. We do at the Fool. Shame people don't share it more broadly because that is a really, really important insight that you just shared with our listeners and viewers.
Thank you very much. It took me a while to get to, and you had to live it to start to realize it. But in the end, it's just simple math.
Hmm.
And there are people who are much more mathematically inclined than I am. Even though I love numbers, I'm a literature major from university, but I truly have recognized now that this goes against our human instincts. Psychologists say the pain of loss is 3 times the joy of gain. That has been proven through behavioral economics, many different studies, all pointing toward a 3-to-1 ratio, give or take. And, that is why we're all on Earth today, because our ancestors thousands of years
Yes.
ago were the ones who ran. They're like, but what if it's really bad? And so it's hardwired into us to experience loss as 3 times more painful than the equivalent in gain. But think about it. The stock market is exactly the opposite. Actually, the joy of gain, we've just talked
Right.
about it, is infinite
Yeah.
times the pain of loss. But we are still living in a world where everybody has the same human hardwiring. And I just try to remind us of the math. And I've tried to prove it through decades of buying and holding and sharing out Scott Phillips's stock picks, David Gardner's stock picks, Fool across the world. We're all, as analysts and advisors, sharing out our best ideas. And I think the ones that work, we should let them. Let them work. Let them win. Be surprised that you could actually make 100 times your money. We've done it 7 times. And part of what I'm trying to do in my book is just A, let people know that's possible. B, we did it. C, here's how. And D, it's not about me. I'm finished picking stocks. It's about you. You following Fool AU, you following your heart, or making your portfolio reflect your best vision for our future.
I love that, David. I am reminded of I said to our members before, you do it much more eloquently. Investing well is really the ability to successfully subdue our evolutionary biology. It's that idea of being able to say, that's what we just did. Our lizard brains, our monkey brains just want to do all these things because we're on the savannah, we're running from the lion. You don't store food for 60 years when you're a caveman who's just discovered fire. And yet, that's what we have to do as investors. We have to look fear in the face. We have to plan for the long term. They are things that just don't come naturally to us, and the ability to get over that line. And that's where the book is so important. You lay out a methodology, but also a proven methodology over that 26 years, as you mentioned, which says to us, you can do this. This is what I thought we should do. This is what I did. This is what the results are. And here's how to put it to work in your portfolio. And you say in your life, which I know you're going to come back to possibly with another book, which is exciting. But that for me is a really key one. Mate, can we finish with a quote that I really like? I know it's one of your favorites, and I'll read it, then you can repeat it because you do it better than I do. I try to find excellence, buy excellence, and add to excellence over time. I sell mediocrity. That's how I invest. And I love that because it encapsulates what you just talked about, including the selling bit. Because you're saying you're buying to hold, which I love, not buy and hold, but buy to hold with the intention. But if the excellence becomes or is discovered to be mediocrity, you're prepared to sell. Would you unpack that quote a bit for us?
I'd love to. So I think obviously I repeat the word excellence 3 times, which
Mm-hmm.
is a reminder that that's really what wins in this world, the best. There are opportunities to pursue cyclical companies where you might time a cycle right once or twice. There are companies that look good but might not be great. But there are people in this world who are truly great. And there are companies that do truly great things, and staying focused on the best and not just flash in the pan best of 2025, but really the next 10 years, who's going to help shape the world for good. It's so satisfying when that happens and you were owning it and believing in it, especially when you were going against the grain because everybody told you that was overvalued. So excellence, excellence, excellence. Try to find it, buy it, and then, of course, add to it over time. We don't try to add to our losers. I add up. This is very contrary, again, for most people. They want to add or rebalance to things that aren't working. You already know what I think of excellence. I want to add to it. And then, yeah, Scott, I do use the word sell. Sometimes people say, David, do you ever sell? Or do you at the Motley Fool ever sell? Of course we do sell. But what we're doing is what people don't do, most of the sellers. Most sellers are looking directly at the stock and a target price they have or an outcome about that stock that they don't like, or the stock market overall. They're thinking about, is it going to crash? Or what about, the market selling off, and they're trying to get out ahead of that. And then even if they do successfully, often they don't get back in at any time that would be successful, and they shouldn't have ever exited in the first place. So, but I do sell. I sell when I look not at the stock chart or stock market forecasts. I look specifically at the company in the eye as best I can. And I say, do I love you? Are you still great? Do I believe that you have good days, not even your best sometimes, good days ahead of you? And if so, I stick with you. And even if you've made a bad mistake, like when Netflix announced Quickster, which is a classic mistake that it is probably the stuff of business case studies here in the U.S., splitting their DVD business from their streaming and rebranding everything and confusing their customers and losing 2/3 of their value with the stock as we held it all the way through and then back up. Or watching watching Amazon, which I had at $3 a share back in the 90s, go to 95 and then back down to 7 during 2001. Extremely hard to do, but I did hold it, and I'm so glad I held those all the way through. So I think that we can sell mediocrity when we truly do think that a company is done. But when Netflix made that mistake, they only lost less than 1 million subscribers. Their financial statements were not, it was a bad decision, but stocks overreact to announcements. The businesses themselves are much stabler. Follow the business.
Love it. You talk about being long-term. I often share the Vanguard index chart. Vanguard produces, I don't know if they do in the US, an index chart here of the Australian market over 30 years. And we are stock pickers. We think we can do better than the index. But I say to people, the very, very least, look at what index investing does. If you can do even better than that, you're ahead. Often I get the response, I said, but all you have to do is, this chart says you bought once, you never added to it, 30 years later, here's what you had. And people say to me, yeah, but who does that? Who holds for 30 years? And my point is like, but that's the point. That's literally what I'm trying to say to you. That's what you should be doing. And what I love about the Amazon story and the other stories you've shared is exactly that. You also, I'll get you to close, mate, if you wouldn't mind, with the story about the second lowest cost base on Amazon in the room, because I think this is a really, really nice description.
Well, thank you. Yeah, this is near the end of my book, and so there's a bit of a spoiler alert here. I might even not fully spoil it, Scott, but thank you.
Okay, no, don't. Please feel free to leave it to the book.
I found myself in a very, very large convention room one night at a big bash in Washington, D.C., our nation's capital, with thousands of people who were there to see Jeff Bezos, the richest man in the world at the time, interviewed in front of a supper time audience. And I had been hoping maybe to get to meet him. And I was telling my wife, Margaret, the night before, if I do get to meet him, Margaret, I've already got my line. I'm going to say, Jeff, I think I'm the guy in the room with the second lowest cost basis in Amazon.com stock. And obviously we know who had the lowest cost basis, the man that I was hoping to address. So my dream was that night, 7 years ago, to buttonhole the world's richest man and let him know that I had the pretty sure, because people don't hold these stocks, right, Scott? Who would ever hold even an index for 30 years? By the way, who wouldn't hold an index for, I hope, at least 60 years? Mm-hmm. I'm a whole life investor. I will be invested my entire life, 100%. I don't exit the market. It's not hard to hold for 30 years at all. I hope to hold for a lot more than that going forward. And did I ever make it to Bezos that night? It was an absolute zoo. There was media everywhere, security, etc. And I made a game effort, I'll say that. And I write about that near the end of my book. Ultimately, it was my favorite chapter probably to write in the book, Scott, because it's about optimism. And I think that optimism in my mind, having visited your fair land before, I believe it's part of the Australian spirit. I think it's part of your cultural and national heritage. And I see a lot of it, always have in the United States of America as well. It's a little bit crazy right now in my fair country, but I hope that the optimism that Scott and I exhibit has come through in this conversation. I believe that optimism is a creative force. It's not just a state of mind. So ultimately, I wanted to write and remind my reader, whether they're Australian or American, of the beauty and power of believing, yes, we can, and how much more likely you are to get it than if you're saying, no, we cannot. And that was, I had a yes, we can effort that night to reach Bezos.
David, you'll be pleased to know, I'm going to do it because I can talk about it. You'll be pleased to know that in my podcast, The Good Oil, we do interview podcast, and this interview will be part of that podcast series. My last question to all of our guests when I do this is a different type of interview. I interview them and I ask them my 4 favorite questions. My last one is always, what are you optimistic about? It's my favorite question. So it's a very nice way to finish this particular conversation. Please go out and buy David's book, Rule Breaker Investing. We'll link to it in the pod feed. We'll link to it below this video on YouTube. If you're watching it on YouTube, go and get a copy. It will pay you back in spades. I'm not just saying that because I work for David, although I do. It is a spectacularly good book, so well written, super readable, short as David mentions, but packed with so much value. You will absolutely thank me for it. I promise you. It will really, if not change your life, certainly change your investing far, far, far more than the price you're going to pay for the book. David, thank you for being so generous with your time. Thank you for writing the book. Thank you for being the fool and a fool. And thank you for joining me for this conversation.
It is my absolute delight. Thank you for the invitation, Scott. And if we didn't get through everything, have me back anytime. I love talking to you. It's always a delight. And fool on to all my Aussie fools.
There you go. Fool on.